Welcome to my first video covering the LLQP course. This video will be covering the first chapter in Module 1, which is just an introduction to life insurance. But before I start, I should disclose that I am currently taking and studying this course myself as of creating this video. So I am by no means an expert at this time, and I'm not insurance licensed upon recording. I'm simply making these videos to help both you and me study for the LLQP exam. Also, these slides are more of a review of the course content, so you should still try and read the textbook when studying for the exam. Now, I do want to go over a brief overview of what my videos are going to be covering. So first off, I am going to make a video on each chapter for each module of the LLQP course. So module 1 is going to be life insurance. I do find that this is actually the easiest module to start out with. We're then going to move on to accident and sickness. Module 3 is going to be about segregated funds and annuities, and Module 4 is ethics and professional practice. So we are going to start today with Chapter 1 of the first module, which is the life insurance module, and there's 3 main topics in today's chapter. 1.1, the risk of death. We're also going to talk about the potential financial impact of death and some risk management strategies. So let's move on to Chapter 1, Introduction to Life Insurance. So risk of death. So life insurance allows people to protect their family from the risk of the insured passing away. Now, when buying insurance, insurance companies assess the individual's risk of death by looking at various factors such as age, gender, family history, health, smoking status, and sometimes job and income level. Using these factors, they calculate the risk of death for that individual. There are 2 ways of looking at this. There is the probability of death and life expectancy. Now, life expectancy is the average number of years that person within a certain group and certain age can expect to live from that age forward. So, for example, a 65-year-old male is expected to live another 19.4 years, which would take them nearly to age 85. You'll notice this is higher than a male that is born today, and that's because the 65-year-old already achieved age 65, therefore the odds that they live past 80 is greater than a male born today. A few takeaways from this table is that women are expected to live longer than men, which does contribute to females typically having a lower insurance premium than males. You can also see how age is the greatest factor for the risk of death, and this is why as you get older, your insurance premium is much higher. And this is simply because the insurance company needs more compensation since the probability of death is greater as you age. The next main topic in this chapter are the different types of financial impact caused by death. And one of the most devastating financial impacts resulting from death is a loss of income. So particularly if one of them is supporting a young family that relied on that income. So suppose you have a husband and wife, and they also have a few children, and one of them passes away. Well, the household income is going to drop, and potentially the surviving spouse may struggle with that loss of income, which is what insurance is supposed to help protect against. Another financial tragedy that can happen as a result of death is a loss of a caregiver. So even the death of a non-income earner can have a significant impact on the surviving family's finances, particularly if the deceased took care of the family's children or other dependent family members. Another financial impact of death is debt repayment. So when a person dies, one of the first responsibilities of the executor of the estate is to pay off any outstanding debts, including mortgages, car loans, and credit card debt. Now, in some cases, the lender may be willing to extend the loan to the surviving spouse or another beneficiary who inherits the property that is encumbered by the debt, but usually only after ensuring that this person has the income needed to make the loan payments. And if the lender decides that the risk of default is too high, they will recall the loan demanding full payment. So in order to protect against this debt repayment, this is another reason why someone may want to take out an insurance policy. Another type of financial impact is income taxes. So the income tax liability that arises upon death, it can seriously erode an estate. So when a person dies, it's usually deemed for that person to have sold all of their property for its fair market value. Estate creation is another reason why a client may want to take out an insurance policy. So when they are contemplating their future death, they often want to leave something behind for their beneficiaries, whether that be their son or daughter or grandchildren. So one way to do this is by taking out an insurance policy. That way they will have something left for their heirs. Business impacts also is another type of financial impact of death. So the death of a key employee or shareholder, it can have a devastating impact on a business, and sometimes it can even result in a collapse of that business. Now, key person life insurance is one way to or one solution for this. But typically, if a key person of a business does pass away, of course, that their share will go to their spouse. And typically, the spouse may not want any part in the business. So for that reason, you might want to take out some key person life insurance. So that way that the business can just buy them out and buy the spouse out once the shares do go into their hands. And the last main concept of this chapter includes some risk management strategies. So first off, you have risk avoidance, and this is basically deciding not to expose oneself to a risk. So for example, a person could avoid the risk of having a car accident by just choosing not to drive a car. Now, risk reduction is usually like taking action to reduce the probability or severity of that risk. So, for example, consider a person who has to drive a car because it is the only option to get to work. Well, they can use a risk reduction strategy to reduce the risk of having a car accident by just obeying traffic rules and making sure the car is in proper condition. Risk retention is most appropriate for risks with low severity, meaning risks with a manageable financial impact. So for example, a person who buys a new appliance and who has the option of buying the extended warranty, well, they can pay for the extended warranty, which will protect themselves if the appliance breaks, but also they can just refuse the extended warranty and retain that risk. So if the appliance breaks, well, then they'll just have to repay it themselves. It isn't too severe of a risk, and they can use that risk retention strategy to just accept that. Risk transfer is finding someone else who is willing to assume the consequences if the risk is realized, and basically this is life insurance. So for example, all of those financial tragedies that I just went over, well, one solution to solve that with a risk management strategy is by using risk transfer, which is basically just transferring that risk off to the insurance company so that if someone does pass away and there is that financial tragedy, well, the insurance company will pay the family the money so that they don't have to deal with that. And basically the insurance company just takes on that risk of having that financial impact if that person does pass away. And so those are all of the main concepts in Chapter 1 of the Life Insurance module. I will be covering Chapter 2 shortly, so stay tuned for that one. And I really hope you did enjoy this video, and hopefully these videos will be helpful for all of you watching. Thank you all for watching, and I'll see you all in the next chapter.